In this video, I'm going to show you how a lessee would account for a finance lease under ASC 842, which is US GAAP. So let's say that the company Lennar agrees to lease equipment from the company Caterpillar. Here are the details of our lease. We've got a lease term of 3 years, and the remaining economic life of the asset is 4 years. So right there, you can see that one of the classification tests for it to be a finance lease has been met. The lease term is for the major part of the asset's remaining life, which is at least 75%, right? 3 divided by 4 is 0.75 or 75%. So we've got it classified as a finance lease, and we've got the lessor's implicit rate of return, which is known to the lessee, that's important, as being 8%. Now the lessee's incremental borrowing rate is 10%, but we're gonna disregard this, and I'm gonna cross it out, because if the lessee knows what the lessor's implicit rate of return is, then the lessee is going to use the lessor's implicit rate when the lessee does any discounting related to the lease liability and so forth, which you'll see in a minute. So we're going to use this rate, 8%, for our time value of money calculations. Now, we've got an annual lease payment of $300,000, which is going to be made at the start of each year. So basically, we've got a 3-year lease term. So the very first payment's going to be made at the beginning of the lease, $300,000, and then there's going to be 2 more payments of $300,000. So 3 payments to $300,000, but we don't record a lease liability of $900,000 because 2 of those payments are occurring in the future, so we need to discount them to their present value. So we got 3 payments of $300,000. That's an annuity, specifically an annuity due, because each cash flow occurs at the beginning of each period instead of the end. So calculate the present value of those lease payments. What we're going to do is use the formula for the present value of an annuity due. So I've got the cash flow, periodic cash flow being $300,000. R for our discount rate is 8% or 0.08, right? And then we've got the number of periods as being 3. So this is just a formula here for present value of an annuity due with N being equal to 3, R being equal to 0.08, and then the cash flow being $300,000. So that gives us a present value of the lease payments, $834,979. Now, in this example, I'm going to assume that there's a guaranteed residual value and that the lessee is expecting the residual value to be the same as that guaranteed residual value. I will, if I have time, I'll make another video where I show you what happens when the lessee has guaranteed a certain residual value, but is expecting the residual value to be lower than that. Long story short, so let's say the expected residual value was $10,000. Then you'd say, okay, the lessee's expecting to be short $40,000. They would basically anticipate they'd make a final lease payment to the lessor of $40,000, and they would have to discount that to the present value and add it to this when calculating the initial lease liability. But we don't have that situation here. Here, we just got straight up present value of the lease payments is going to be our initial lease liability. So I've got a lease amortization table that I put together. I'm also going to show you journal entries throughout for each of these things. So our initial lease liability, again, $834,979. That was calculated right here. So that's just the present value of the lease payments. Now, I've broken out into 2 dates, January 1st, 2024, because I wanted to show you, number one, here is the initial lease liability, but at the beginning of the lease, there's immediately a lease payment, which reduces that lease liability to $534,979. So on January 1st, we start here with our initial lease liability, but then we immediately go down to $534,979. And you might say, well, why does that matter? Well, that matters for purposes of calculating the interest expense on the lease liability. We're going to use this amount, $534,979, and multiply that by the lessor's implicit rate of 8%. So this times 8% is going to be $42,798. So that's where we got the interest expense. Okay, we take the lease liability, we multiply it by the lessor's implicit rate, gives us the interest expense. Now notice, the interest expense is going to increase the lease liability. So the lease payments reduce the lease liability. We went from $834,979 to $534,979. But then the interest expense is incurred. When we debit interest expense, we credit the lease liability, so lease liability goes up. So basically it's $534,979 plus $42,798 okay, is equal to this. Now, technically, if you do the calculations by hand, you'll see it's off by $1, and that's because I left the pennies off for each of these examples, just rounded to the nearest dollar. So you see that'd be off by $1 if you did it by hand. Okay, now, let me just scroll ahead. I'll show you the journal entries real quick, and then we'll come back. So here is our initial right-of-use asset being debited for $834,979, and our lease liability for being credited for $834,979. And then when we have that first lease payment, we debit the lease liability for $300,000 and credit cash. Now, the interest expense, and pay attention to this side here, this is the next year. So when we get to the interest expense, as I said, we debit interest expense and then credit the lease liability for $42,798. Now, you'll notice this amortization expense entry, where we debit the amortization expense, credit the right-of-use asset, that doesn't appear in the lease amortization table, because that lease amortization table is just showing how the lease liability is amortized over time and the interest expense recorded. So this amortization expense, the way you get that is you take the initial right-of-use asset and divide that by 3, okay? And if you're wondering, this initial right-of-use asset, in this case, it's equal to the initial lease liability, but it could be different if you had a situation, for example, if you had the lessee incurred some initial direct costs, they would be added to the right-of-use asset. So they're not always going to be the same. So those are just some little tidbits of information. Let's get back to our amortization schedule. And then I'll show you the rest of the journal entry. So we left off here. We got the lease liability. Now we got the beginning of year 2 of the lease. There's a payment made. There's the payments are made at the start of the period. So we go from 577, 778 down 300,000. Now the lease liability 277,778. Now we take this, we multiply it by the lessor's implicit rate, 8%, and we get this, our interest expense for year 2 of the lease, $22,222. Now, we had said that that's going to increase. It's going to increase our liability. So that gets added to this plus this equals our updated lease liability, $300,000. Now, beginning of year 3 of the lease, we have our final lease payment, $300,000. And so the lease liability is extinguished. It's going to be at 0. Notice that in this particular example, there's no interest expense recorded in the 3rd year of the lease. You just have year 1 of the lease, there's some interest expense, year 2 of the lease. It won't always be like that. For example, if you had a bargain purchase option, and you're assuming the lessee is going to exercise this option to purchase the asset at the end of the lease, then that would be treated as a final payment to the lessee at the very end of the lease. So then in year 3, there would be the liability wouldn't be immediately extinguished with that final payment, the final lease payment, because there'd be the additional payment of exercising the purchase option at the end. I'll make a video with that. With a bargain purchase option. But in any event, the key is it's sometimes there won't be interest expense incurred by the lessee in the final period of the lease, and sometimes there will. Now, notice that the interest expense gets lower over time, right? Because the lease liability is decreasing. So you'll notice this is a difference from operating leases. The amortization expense is going to be the same each period. You see here we've got the same entry for amortization expense, but the interest expense is getting lower. Okay, so we have the interest expense declining. So basically the total lease-related expenses incurred by the lessee are going to get lower each subsequent year of the lease for the lessee, and when it's a finance lease. When it's an operating lease, that's not the case. So again, here we had the entries for 2025, and then we have the final entries are January 1st, 2026, the final lease payment. We debit the lease liability and we credit cash. But then also we have the final entry for amortization expense. Now notice it's 278,327 instead of 278,326. Again, it comes to a rounding thing. It was basically like 278, 326, and 33 cents, and so I just rounded. That's why. But we basically, by the end, the right of use asset should be brought to 0. So we're amortizing that over time and getting it down to 0. So the lease liability at the end of the lease will be equal to 0, which we can see in our lease amortization table. We eventually get the lease liability to 0, but we also need to have fully amortized the right of use asset by the end of the lease term.